Imagine walking into a casino, right? You sit down at a table where you mathematically lose money, like 90% of the time.
Which sounds like a terrible way to spend an evening.
Exactly, just an awful idea. And yet somehow you walk out a multimillionaire. It sounds completely impossible, like a glitch in the matrix or something.
It really does. But according to some of the smartest institutional wealth managers on the planet, this deeply counterintuitive math is exactly how the most resilient financial portfolios in the world are built.
Welcome to the special Wealthnetic Deep Dive. We are so thrilled you're joining us today because, well, here we are in mid-2026, and let's be honest, the economic landscape feels incredibly chaotic right now.
Yeah, the ground is entirely shifting beneath our feet.
Hmm.
The traditional financial strategies, the ones that were built for those relatively calm decades of the late 20th century, they're fundamentally breaking down in real time.
Right. And our mission for this deep dive is to equip you with the mental frameworks to navigate that breakdown. We want to completely redefine how you view risk, how you build wealth, and how you handle market turbulence.
And we are pulling from a really incredible stack of sources today to do this.
We really are. We're looking at the comprehensive In Gold We Trust report, the groundbreaking concepts from the book Antifragile, a strategic review on safe haven investing, an incredibly sharp institutional brief from Parabellum advisors on managing tail hedges, and a recent survey on how everyday retail investors are using artificial intelligence.
It is a powerhouse collection of insights. When you synthesize all these separate documents, a very clear, very urgent warning emerges about the fatal flaws in how the majority of the population still manages their life savings.
Okay, let's unpack this. I want to start by examining the foundational rule of investing that practically every financial advisor has preached for decades, the legendary 60-40 portfolio.
Ah, yes, the golden rule.
Right, 60% in stocks for growth, 40% in bonds for safety. But our sources are telling us this rule is basically a walking zombie. Why is that?
So to understand why it's failing today, we have to look at the underlying mechanics of what the 60-40 portfolio actually was. In behavioral economics, 60-40 wasn't some, immutable law of physics. It was a heuristic.
A heuristic, meaning like a mental shortcut.
Exactly. It's a rule of thumb that helps human beings make decisions under immense uncertainty so they don't have to perfectly calculate every single variable in the global economy.
Basically, a good enough solution for a paralyzingly complex problem.
Exactly that.
Yeah.
And for decades, basically, from the early 1980s right up until around 2020, that heuristic worked beautifully. But it only worked because we were living in a very specific, anomalous historical era.
The era of peaceful disinflation.
Right. Peaceful disinflation.
Let's define that for a second, because I feel like people often confuse disinflation with deflation. Disinflation doesn't mean prices are actually dropping, right?
No, not at all. It just means the rate at which prices are rising is slowing down.
Got it.
That's a crucial distinction. We had a long period where inflation was gradually cooling off. And because inflation was cooling, central banks had this ultimate superpower.
Which was cutting rates.
Exactly. Whenever the stock market took a hit and the economy stumbled, central banks could comfortably step in and cut interest rates to stimulate growth.
And that's where the magic of the 60-40 comes in, right? Because bond prices move inversely to interest rates.
Yes. When central banks cut rates, the value of the bonds you already held went up. So your 60% in stocks would drop, but your 40% in bonds would shoot up, acting as an automatic shock absorber.
Delivering incredibly consistent, smooth returns.
Exactly. But the macroeconomic weather pattern changed. We're no longer in an era of peaceful disinflation.
No, we definitely aren't. Over the last few years, we've seen sticky, stubborn inflation, massive sovereign debt issuance, shifting geopolitical supply chains.
Right, so central banks can't just slash rates to zero at the first sign of stock market trouble anymore. Because if they did that, it would pour gasoline on the inflation fire.
Which means the shock absorber is entirely broken.
Completely broken. In recent stress events, we've seen stocks and bonds plummet at the exact same time. The math of the 60-40 portfolio is failing.
Yeah.
Yet, what the sources highlight is this terrifying behavioral psychology that's keeping this dead strategy alive. For everyday retail investors, the culprit is recency bias.
Meaning they just expect the market to eventually normalize.
Yeah, they think it'll just go back to behaving the way it has for the entirety of their adult lives.
Okay, but what about the professionals? The institutional fund managers who manage billions of dollars in pension funds? I mean, they see the same data we do. They should know the shock absorber is broken.
Oh, they do know. But they are trapped by an entirely different psychological cage, which is career risk.
Career.
Yeah. The financial industry's incentive structures heavily reward conformity. If you manage a major fund, your performance is judged quarterly against industry benchmarks and your peers.
Right, you have to keep up with the pack.
Exactly. There is a famous economics saying that perfectly captures this. It is better for your reputation to fail conventionally than to succeed unconventionally.
Wow. Because if you stick to the traditional 60/40 model and you lose your clients' money, you can just point to the TV and say, hey, don't blame me, the whole market was down.
Right. You say, look, my peers lost money too.
And you get to keep your job.
Precisely. But if you deviate from the norm, you move heavily into unconventional hard assets to protect against inflation, and you happen to underperform the stock market for just 1 or 2 quarters.
You get fired for being a rogue manager.
You're out. So the industry clings to the old heuristic because it is socially and professionally safe, even if it is mathematically doomed.
So clinging to the traditional 60/40 right now is essentially like using a street map from 1990 to navigate a modern, heavily constructed city. You're going to drive your car straight into a river.
A river of financial ruin. Yep.
But hey, at least all the other fund managers are driving their cars into the river right alongside you.
Exactly. The herd mentality is incredibly strong. However, the In Gold We Trust report offers a very specific, adaptive solution. They propose a new 60/40 portfolio designed specifically for the inflationary, volatile realities of the mid-2020s.
Okay, let's break down the mechanics of this new version. How does it operate differently?
Well, the 60% traditional side shrinks dramatically, becomes 45% stocks and only 15% bonds.
That's a massive shift away from bonds.
It is. The truly radical change happens in the remaining 40%, which is dedicated entirely to diversified hard assets and alternatives.
What does that look like specifically?
The report breaks this down into 15% safe haven physical gold, 10% in what they call performance gold, which includes silver and precious metal mining equities, 10% in broad commodities, and 5% in Bitcoin.
I want to pause on the mechanism there because just listing those assets sounds like a recipe for a heart attack to a traditional investor. I mean, why do broad commodities and Bitcoin act as shock absorbers today when bonds used to do that job?
It really comes down to what you're actually trying to absorb. In the 90s, you were absorbing deflationary growth shocks. Today, you are absorbing inflationary currency shocks.
Right, because the money itself is losing value.
Exactly. Broad commodities, think copper, oil, agriculture. They are the raw, physical materials of the global economy. They have intrinsic utility.
So if inflation surges because the fiat currency is losing purchasing power, the nominal price of those raw materials is quite literally what is surging.
Exactly. They hedge against the exact force that is currently destroying bond yields.
And what about Bitcoin?
Bitcoin operates as a non-sovereign, decentralized network entirely outside the traditional banking plumbing. It introduces an asset with a strictly capped supply into a world of uncapped fiat currency printing.
So if the old shark absorbers are broken and the new 60/40 introduces highly volatile assets like mining equities, commodities, and Bitcoin, we aren't just trying to passively survive economic shocks anymore.
No, not at all.
We are intentionally injecting volatility into the portfolio. We're actually trying to build a system that feeds on it, which requires a total redefinition of the word fragile.
Yes, it does.
I want to dive into the core concepts from the book Antifragile, because most of us assume the opposite of fragile is strong or robust, but the author argues that is a massive misconception.
It is a profound mindset shift. To illustrate the difference, think of a glass vase sitting on a table. If you knock it off and it hits the floor, it shatters. It is fragile. It is actively harmed by stress, shock, and disorder.
Right, pretty straightforward.
Now, think of a solid steel block. You drop it off the table, it hits the floor, it clatters loudly, maybe it dents your hardwood, but the block itself is totally fine.
So that's robust.
That is robust. It resists the stress. But here is the key. The steel block doesn't get any better because you dropped it. It just stubbornly stays the exact same.
It survives, but it doesn't evolve.
Exactly. An anti-fragile system is entirely different. Anti-fragile things actually require shock, volatility, and disorder to improve, grow, and thrive.
Like what? Give us an example.
Think of the biology of your own muscles. When you go to the gym and lift heavy weights, you are intentionally putting your muscle fibers under extreme stress, creating microtears.
Yeah, you're literally damaging them.
Right. And your body responds to that localized disorder by overcompensating and rebuilding those fibers stronger than they were before. Your muscles are anti-fragile.
Okay, I love that analogy.
The core thesis of the book is that in a highly unpredictable, chaotic world, merely trying to build a robust financial portfolio that just survives is a fool's errand. You need to build a portfolio that uses market crashes as fuel for growth.
Okay, but translating biology to finance is where people get lost. How do we actually build financial muscle?
Well, if we connect this to the bigger picture of portfolio construction, it leads us directly to what the author calls the barbell strategy.
The barbell strategy. Okay, explain that.
The traditional financial advisory industry tries to shove everyone into the middle, the medium risk bucket. Think of a standard, balanced mutual fund. But the author argues that the middle is mathematically the most dangerous place you can possibly put your money.
Because it provides the illusion of safety, but hides systemic risks.
Right. In the middle, you are exposed to catastrophic tail risks.
Tail risks being those rare, extreme events.
Exactly. Rare events that can wipe out seemingly safe corporate bonds or blue chip stocks. But because it's a balanced fund, your potential upside is strictly capped. You take on invisible risk for mediocre rewards.
Sounds like a terrible deal when you put it like that.
It is. So the barbell strategy dictates that you completely abandon the middle. On one end of the barbell, you put a significant portion, say 20% of your portfolio, into ultra-safe, practically zero-risk assets.
Like what?
We are talking short-term, U.S. Treasury bills, physical cash, fully insured bedrock holdings. You guarantee your survival.
And on the other end of the barbell.
You put the remaining 80% into extreme high-risk, high-reward opportunities with asymmetric upside.
Hold on. Let me push back on that heavily. 80% in extreme risks.
I know how it sounds.
If I go home tonight and tell my partner that I'm putting 80% of our retirement savings into wild, speculative, high-risk bets, I am going to be sleeping on the couch for the rest of the year. Probably forever. How is that remotely safe?
It's a very natural reaction. But the misunderstanding is in how that 80% is deployed. You aren't putting 80% of your net worth on black at the roulette table.
Okay, good.
You are taking that capital and distributing it across multiple, highly speculative, asymmetric bets, like venture capital, aggressive commodities, or out-of-the-money options.
So the key word is asymmetric.
Exactly. The absolute worst-case scenario for any of those individual bets is that it goes to zero. Your downside is strictly capped at the capital deployed. But the upside...
It could be massive.
Right. If just one of those risky bets hits, it might return 1,000 times your initial investment. And because your 20% bedrock is utterly secure, you can afford to let the risky bets run wild. You limit your downside completely, but leave your upside entirely uncapped.
I see. So because you know you absolutely cannot be wiped out, you have the psychological and financial staying power to endure the volatility of the high growth side.
Precisely.
Which perfectly brings us to the most counterintuitive part of the source material today. I was reviewing the math in the summary of the book Safe Haven, and we need to talk about hedges and portfolio insurance.
Oh, this is fascinating math.
It is, because the book implies that buying an asset that loses money most years can somehow make you richer in the long run. How does bleeding money on an insurance premium lead to wealth accumulation?
To grasp this, we have to look under the hood at the math of compounding. Specifically, we need to understand the profound difference between arithmetic returns and geometric returns.
Walk us through the mechanism of that, because people usually conflate the two.
They do. So let's use a brilliant dice game analogy from the author of Safe Haven. Imagine you and I are playing a game with a standard six-sided die to determine your investment returns for the year.
Okay.
If you roll a 1, you suffer a catastrophic loss. You lose 50% of your total portfolio.
Ouch.
Right. But if you roll a 2, 3, 4, 5, or 6, you gain a little bit of money, say 15%. Now, if you just look at the simple arithmetic average of those outcomes on a spreadsheet, the game looks like a winner.
Well, yeah, because 5 times out of 6, I'm making a solid 15% profit.
But the reality of geometric compounding, which is how money actually grows in the real world over time, is brutal.
How so?
If you start with $100 USD and you roll a 1, you lose 50%. You are down to $50. To get that $50 back up to your original $100, you don't need a 50% gain. You need a 100% gain.
Oh, wow. You need a total doubling of your money just to tread water and get back to zero.
Exactly. And that takes years. Massive portfolio drawdowns destroy the geometric compounding of your wealth. This raises an important concept, convexity.
Convexity?
That's a mathematical term. But in finance, it means a nonlinear, explosive payoff. A true safe haven asset, a tail hedge, has massive convexity. It acts as disaster mitigation.
How does it behave normally?
It might bleed a tiny bit of value during the 5 years the market is doing well, creating a negative arithmetic return for that specific asset. But when you finally roll a 1 and the rest of your portfolio drops by 50%, that highly convex hedge explodes in value.
Right. You risk $1 to potentially make $50 in the rare event of a total market panic.
Exactly. And by mathematically preventing that massive 50% setback in your total portfolio, the safe haven drastically boosts the compounded long-term growth of your total wealth. You end up far richer.
So good defense mathematically leads to good offense. You build immense wealth simply by avoiding the big zeros.
That's the secret.
But, and this is a vital caveat, the institutional brief we analyzed from Parabellum advisors outlines a fatal error that even seasoned professionals make when holding these convex hedges.
Yeah, this is a huge trap. The error is believing that merely owning the hedge is the finish line.
What's the reality?
The Parabellum brief stresses a harsh reality. Tail hedges are wasting assets. Let's say a major global crisis hits. The stock market crashes. The value of your convex hedge spikes exponentially.
Right, you log into your brokerage account and you have massive unrealized paper gains. You feel like a genius.
You do. But what inevitably happens next? Governments step in, central banks announce emergency liquidity, policy support arrives, and the initial panic begins to subside. The moment that normalization begins, the value of your hedge decays incredibly fast.
So if you just sit there paralyzed, staring at your screen, feeling smart because your portfolio insurance is up 300%,
It's gone.
that value will just evaporate back into the ether.
Yes. A hedge is not a philosophical statement about the end of the world. It is a liquidity instrument. Its sole structural job is to convert crisis dislocations into usable USD cash.
So you have to cash it out.
If you do not monetize the hedge, meaning if you do not actively sell it into the market panic when it spikes to raise cash, it's completely useless. You have to take those cash profits and use them to buy up high-quality assets at rock-bottom fire sale prices while everyone else is forced to liquidate.
That is the actual mechanism of how convexity builds wealth. Here's where it gets really interesting, because we actually have real-world case studies of these complex concepts playing out in real time. Let's look at the first case study from the In Gold We Trust report, which focuses on gold mining companies.
Right.
Historically speaking, investing in gold miners was a phenomenal way to set your wealth on fire. The report notes that over the past couple of decades, the mining industry managed to destroy around $500 billion in shareholder value through terrible acquisitions, massive debt loads, and skyrocketing operational costs.
They were the ultimate poster child for a fragile business model.
Yeah.
I mean, they required gargantuan amounts of upfront capital just to build a mine, and their profit margins were constantly squeezed by the rising costs of energy, labor, heavy machinery.
But the report highlights a massive structural shift happening right now. Instead of just pulling raw gold out of the ground and immediately selling every single ounce for fiat cash to fund their operations, some of the smartest miners are now holding a percentage of the physical gold they mine directly on their own corporate balance sheets.
Which is brilliant.
What is the mechanism making that so powerful?
It acts as a perfect, self-contained hedge against their own cost inflation. Mining is an incredibly energy-intensive business. If global inflation spikes, the cost of the diesel fuel required to run their massive trucks goes through the roof.
Right.
In the past, that diesel spike would instantly crush their profit margins. But now, if inflation spikes and fiat currency loses value, the nominal price of the physical gold sitting comfortably on their balance sheet also spikes.
Wow. They are essentially holding the antidote to their own operational poison.
It is brilliant corporate structuring. By holding physical metal, they transform from fragile problem children into model students of antifragility. They went from just being extractors to acting as custodians of sound money.
The very economic volatility that used to bankrupt them now actively strengthens their balance sheets.
Exactly.
And we are seeing this same push for antifragility happen at the individual level, too. Our second case study revolves around how everyday retail investors are evolving. We reviewed a fascinating recent survey from an investing platform.
Yes, this was really eye-opening.
They surveyed over 900 U.S. investors, and a staggering 62% of them are now heavily utilizing AI tools like advanced chatbots to assist with their investment decisions.
And the performance metric is the critical takeaway here.
Sure.
Of those using AI, 65% reported that it has actively and measurably improved their market performance.
Why do you think that is?
The primary reason is that AI acts as a psychological buffer. It strips emotion out of the equation.
Well, hold on. I need to catch something here. Let's go back to our definitions from earlier.
Sure.
Earlier, you explicitly defined robust as merely surviving stress without breaking like the steel block.
Yes.
If an AI chatbot simply prevents a retail investor from emotionally panic selling at the bottom of a market crash, isn't that just making them robust, not anti-fragile? It's preventing a fatal mistake, sure, but the portfolio isn't actually gaining from the chaos.
That is a brilliant distinction, and you hit the nail on the head regarding the investor psychology.
Mm.
The investor's mind becomes robust. It doesn't break under pressure,
Right.
but that psychological robustness is exactly what allows the portfolio to become anti-fragile.
How so?
Because the AI helps you maintain discipline and hold on to your cash during the panic, you are the only one left with liquidity. When the entire market is crashing and human investors are panic selling blue chip stocks for pennies on the dollar, your AI-assisted discipline allows you to step in and buy those assets at deep discounts.
Ah, I see. You are actively feeding on the disorder created by the emotional fragility of the broader market.
Exactly. The discipline allows you to execute the gains.
That makes perfect sense. So what does this all mean for you, the listener? How do you take these high-level philosophical concepts, heuristics, the barbell strategy, convexity, and actually apply them to your own financial architecture today?
Well, we need to make it actionable.
Let's break it down into 4 highly practical, Wealthnetic-style takeaways. I'll kick us off. Tip number 1, build your goalkeeper.
I love this analogy. If you think of your wealth like a soccer team, your high-growth tech stocks or venture bets are your strikers. But your strikers can't win the game if your goalkeeper lets every single shot into the net.
Right.
Before you go hunting for explosive, high-risk assets, you need an anchor. You need a designated portion of your portfolio whose sole job is absolute capital preservation. Whether that is physical gold in a vault, ultra-safe short-term treasury bills, or highly calibrated tail hedges, you must have an anchor to absorb macroeconomic shocks so you stay in the game.
Perfect. Tip number 2, practice via negativa. This is a Latin concept that translates to improvement through subtraction.
So important.
Too often, when our portfolio is underperforming, our human instinct is to hunt for the perfect new stock to add to the pile to save it. But the fastest, most effective way to improve your financial life is usually by cutting out the bad.
Yeah, pruning the dead branches.
Exactly. Actively audit your holdings. Sell off the fragile, debt-heavy companies. Dump the confusing medium-risk mutual funds that cap your upside but leave you exposed to hidden tail risks. Improve your portfolio's resilience by surgically removing the weak links.
That is incredibly effective, which naturally aligns with tip number 3, demand skin in the game. Never put your money into a complex instrument you do not deeply understand.
Good rule of thumb.
But more importantly, look at the people giving you advice. If you use a financial advisor, a wealth manager, or even follow a market analyst, strictly verify that they have personal financial exposure to the exact same risks they are recommending to you.
Put their money where their mouth is.
Right. If an engineer builds a bridge, they should have to stand under it while the traffic drives over. If your advisor isn't eating their own cooking, do not consume their advice.
I love that standard. And finally, tip number 4, have a crisis cash-out plan. This ties directly back to that stark parabellum warning about wasting assets we talked about.
Yes, don't just sit on the paper games.
Right. If you do take the leap to buy portfolio insurance or convex safe havens, you must decide today, while you are calm and rational, exactly when and how you will sell them to raise USD cash during a crash.
Write the specific exit triggers down on a piece of paper.
Exactly. Do not wait for a 30% market drop to happen and then hope you'll perfectly time the bottom. Indecision will destroy your convex safety net while you wait for the perfect exit that will never come.
The pre-planned execution of taking profits into cash is what grants you the supreme power to act boldly when the rest of the world is paralyzed by fear.
What a phenomenal roadmap. To bring all of this together, thriving in the turbulent economy of 2026 isn't about predicting the future with a crystal ball.
No, nobody can do that.
It is about fundamentally dropping outdated, fragile mental shortcuts like the old 60-40 rule. It's about accepting that extreme volatility is the new normal and deliberately structuring your financial life using the barbell strategy, placing impenetrable absolute safety on one side and bold, mathematically capped extreme opportunity on the other.
It demands a total paradigm shift. You have to move away from a defensive posture of fear, where you just hope to survive, into an offensive posture of deep preparedness.
If this deep dive resonated with you, please hit that subscribe button to join the growing Wealthnetic community. Share this deep dive with a friend or family member who might still be relying on that 1990 map to navigate today's chaotic economy.
We definitely need to hear it.
And as always, we highly encourage you to dive into the original source materials we discussed today to keep expanding your own knowledge. As we wrap up, we want to leave you with one final thought to mull over regarding your personal financial journey.
What's fascinating here is that when the violent winds of economic uncertainty start blowing, the overwhelming instinct for most people is to build thicker, stronger walls to hide behind. But the truly anti-fragile investor looks at that same storm entirely differently. They don't build walls, they build windmills. Take a hard, intellectually honest look at your portfolio today. Are you just building walls hoping they hold up, or are you building windmills to harness the storm?